Hello. We're back again. It's the weekend of the 1st of February. There's been a couple of things that have been taking place in the news, more especially with the new administration in the US, President Trump. This morning, he has signed a package of tariffs that affect Canada, Mexico, and China. 25% tariff hikes on Canada and Mexico, and 10% further hike on tariffs on China. And we have seen the Trump administration talking about tariffs. Last week, we know that when there was an issue on deporting the citizens of Colombia, when the Colombian government would not allow the U.S. plane that was deporting the illegal immigrants to land in Colombia, President Trump had prepared a raft of tariffs that were going to affect the Colombian country. And as a result, there was an amicable solution that the politicians got into. So the reason I want to talk about tariffs is not from the political standpoint, but it's from us who are trading. What impact do tariffs have on markets? And here we're talking different types of markets, whether you are trading cryptocurrencies, you are trading commodities, you are trading stocks. What impact do tariffs have? And therefore, we will be talking about that. And then in the second segment, I want to focus exclusively on the impact on trading markets. Tariffs are taxes imposed on imported goods. They are a central tool in international trade policy. They influence not only the flow of goods between countries, but also impact domestic markets, consumer prices, and broader economic indicators such as inflation and the GDP. There are mechanisms and the comparative impacts on exporting, which is the selling side, importing countries, that is the receiving side. Also, with other economic effects that they have is what I'm planning to discuss with you in this episode. If we just looked at their definition purpose, taxes levied by governments on goods imported from other countries, they serve multiple purposes. One, it could be revenue generations. Tariffs can provide a source of government income. Two, it could be protecting domestic industries. By raising the cost of imported goods, tariffs help domestic producers compete against foreign competitors. And the last one is the political and strategic objectives. Tariffs can be used as a bargaining tool in trade negotiations or penalize certain countries. And I think this is what we're starting to see now in global affairs with the Trump administration and therefore what's happening in other countries. What are the types of tariffs that are there? It could be the VAT or the ad valorem tariffs. They are levied as percentage of value of imported goods. Could be specific tariffs that are levied as fixed fee per unit of imported good. It could be compounded tariffs, a combination of both ad valorem as well as specific tariffs. So what is their effect on international trade? Impact on trade flows. One, they reduce import volumes. Tariffs increase the cost of foreign goods, which often leads to the decline in volume of imports as consumers and businesses shift towards domestically produced alternatives. The second one, it's trade diversion. Higher tariffs can encourage countries to source goods from nations with lower or no tariffs, potentially altering traditional trade patterns. And the last one, third one, retaliation and trade wars. The imposition of tariffs can lead to retaliatory measures where affected trading partners impose their own tariffs, escalating into a trade conflict that reduces global trade efficiency. And this is what we have seen between the US and China. So what are the comparative impacts on exporting and importing countries? If you look at the impacts on importing countries, both the consumer and the economy, higher prices for consumers. So one is what affects the consumer. Tariffs raise the cost of imported goods. For consumers, this generally means higher retail prices, reducing purchasing power, and overall consumer welfare. 2, they reduce the product variety. With imports being more expensive or fewer in number, consumers may have access to a narrow range of products. 3, inflationary pressure. As the cost of imported inputs, that is raw materials and intermediate goods, rises, production costs can increase, potentially leading to higher consumer prices across various sectors. And the third one and the last one, domestic industry production. While tariffs can shield domestic industries from international competition, this protection might lead to inefficiencies if domestic producers do not face competition pressure to innovate or reduce costs. So what is the impact then on the exporting country or the selling country and its consumer? 1, it reduces the market access. Tariffs imposed by other countries can make exports from the selling countries less competitive in foreign markets. And this can lead to lower export volumes and reduce revenue of domestic producers or revenue for domestic producers. 2, potential for surplus production. If domestic industries rely heavily on exports and face declining foreign demand, they might produce more than the domestic market can absorb, leading to oversupply or depressed prices domestically. 3, limited direct impacts on exporters' consumer. Consumers in the exporting countries may not face higher prices on imported goods directly, unless retaliatory measures are taken. But the broader economic impact, such as reducing business revenues and potential job losses in the export-oriented sectors, can indirectly affect their economic well-being. The last point, the long-term structural changes. Persistent tariffs in markets might force exporters to diversify or innovate, sometimes resulting in positive long-term changes, but often causing short-term disruptions and economic uncertainty. What are the broader economic impacts? For example, let's look at inflation, okay? 2 points on inflation. 1, the direct contribution to inflation. Tariffs increase the prices of imported goods and inputs, which can directly lead to higher consumer prices. This is particularly significant in economies that rely heavily on imports for essential goods like food, energy, or raw materials. The second most important one, cost push inflation. Higher cost for imported intermediate goods can cause domestic producers to raise their prices, contributing to cost push inflation, a situation where production costs drive overall price increase. Let's talk about now the general economy, economic growth and GDP. Potential reduction in GDP, gross domestic product. If tariffs significantly reduce the volume of international trade, the resulting inefficiency and higher production cost can lower overall economic productivity and GDP. 2, redistribution of income. While tariffs may protect domestic jobs in specific industries, the higher cost imposed on consumers can reduce overall disposable income, potentially offsetting some of the gains in protected sectors. The last point, which is inefficiencies and resources misallocation. Protectionist policies like tariffs can lead to a misallocation of resources. Domestic industries that are protected from international competition might not have the same incentives to innovate or improve efficiencies, potentially hindering long-term economic growth. Now let's talk about trade relations and global supply chains. 1, the disruption of supply chains. Modern production often relies on global supply chains. Tariffs can disrupt these networks, increasing costs and complicating production processes for multinational companies. 2, negotiation leverage, right? Tariffs are often used as a bargaining chip in international trade negotiations. While they can provide short-term leverage, long-term reliance on tariffs can damage diplomatic relations and lead to prolonged trade disputes. 3, importing countries. Consumers face higher prices and reduced product varieties, while domestic industries might benefit from reduced competition, albeit at the cost of potential inefficiencies and inflation. The next point is exporting countries. Domestic producers may struggle with decreased access to key export markets, leading to potential revenue losses and economic instability in export-dependent sectors. And the other point, on the overall economy, tariffs can contribute to inflation, alter GDP growth patterns, and disrupt efficient resource allocation and global supply chains. The net effect depends on the structure of the economy, the scale of tariff imposition, and the responses of trading partners. Understanding the multifaceted impacts of tariffs help policymakers weigh the trade-offs between protecting domestic industries and the broader economic costs associated with reduced trade inefficiency or efficiencies and increased consumer prices. Tariffs, as taxes imposed on imported goods, can have a ripple effect through the financial trading markets in complex and sometimes unexpected ways. Although their primary intent is to protect domestic industries or generate revenue, the imposition of tariffs creates shifts in market expectation and risks perceptions that affects a variety of trading instruments. Now, let's talk about the direct impact on commodities markets. If you look at the supply-demand dynamics, tariffs on imported raw materials such as steel, aluminum, or agricultural products can disrupt global supply chains, leading to a shortage or oversupply in certain regions. For example, if a country imposes tariffs on imported steel, domestic steel prices may increase due to reduced foreign competition, while downstream industries like automotive or construction could see cost pressures. The next point on futures and options volatility. An example, when the US imposed tariffs on steel and aluminum, commodity futures for these metals experienced increased volatility. Traders speculated on price adjustments based on anticipated changes in supply and demand, causing price swings in the short term. Risk premiums. Uncertainty about tariffs' duration and retaliatory measures can lead to higher risk premiums embedded in commodity derivatives, affecting pricing and trading volume. Let's talk about the stock market. And let's look at the sector-specific effects in the stock market. Import-dependent industries, companies that rely on imported raw materials or components, e.g. technology, automotive manufacturers, may face higher production costs, potentially squeezing profit margins. For an example, a technology firm that sources semiconductor components from overseas might see its stock decline if tariffs increases components cost, or if there's an anticipation of reduced profit margin. On export-oriented, firms that heavily depend on exports may suffer if foreign tariffs are imposed on their products, leading to revenue losses and a negative impact on stock prices. What about the investor sentiment and market volatility? The broader market impact is uncertainty about tariffs policies can lead to market-wide sell-offs, increased volatility, or sector rotation. For example, during trade disputes, technology, manufacturing, and agricultural sectors often experience heightened volatility as investors adjust their portfolios to mitigate risk. And what about the earnings forecast? Earnings forecast revisions. Analysts may downgrade earnings forecast for companies affected by tariffs, further impacting the share price. Let's talk about the crypto market. What are the direct and sentiment-driven effects in the crypto market? Risk-off sentiments. Although cryptocurrencies are not directly traded across borders in the same way as physical goods, they are highly sensitive to global risk sentiments. When tariffs escalate trade tensions, investors might perceive a higher overall risk, leading to increased volatility in the crypto market. For an example, during periods of heightened trade uncertainty, Bitcoin and other major cryptocurrencies have sometimes experienced sharp price fluctuations as investors seek or retreat from alternative assets. Currencies and liquidity effects. safe haven behavior. In some cases, cryptocurrencies might be viewed as a hedge against fiat currency devaluation if tariffs continue to contribute to inflationary pressures. However, this behavior is inconsistent as regulatory and market dynamics also play a strong role. What about speculation and arbitrage? Increased speculation, traders might use crypto derivatives to hedge against or speculate on the macroeconomic impact of tariffs, leading to greater trading volume and more pronounced short-term volatility. Okay, let's look at the forex markets. What impacts are there? Like currency valuation and trade balances. If you look at the exchange rate fluctuations, tariffs can alter trade balances by reducing imports or exports, affecting the demand for domestic versus foreign currencies. For example, if a major economy like the US imposes tariffs, its currency might depreciate due to concerns over slower economic growth, or it could appreciate if tariffs are seen as a measure to protect domestic industries. Market speculation and expectations on positions. Well, traders in forex market closely monitor tariff-related news, positioning themselves based on expectations of monetary policy adjustments and overall economic impact. Bonds and fixed income markets. Well, credit risk and interest rates dynamics. On corporate bonds, companies facing higher production cost or reduced revenues due to tariffs may see their credit ratings affected, leading to wider bond spreads. For an example, a manufacturer that relies on imported inputs might experience worsening credit metrics if tariffs significantly raises its cost, prompting investors to demand higher yields. On government bonds, tariffs can influence inflation expectations and economic growth forecasts, impacting central bank policies. If tariffs contribute to rising inflation, central banks might tighten monetary policy, which in turn can lead to higher yields on government bonds. What about other financial instruments? If you look at derivatives and ETFs, sector-specific ETFs tracking sectors such as industrials, technology, or commodities may experience increased volatility as tariffs affect their underlying companies. On options and futures, the derivative markets provide instruments for hedging against or speculating on the effects of tariffs. For instance, options on stocks indices and specific stocks might see increased premium as probability of adverse outcomes rises. So in conclusion, the imposition of tariffs sets off a chain reaction across various trading markets. Commodity markets expect price increases and heightened volatility due to supply disruption. Stock market, sector-specific impacts will vary with import-reliant firms and export-orientated companies facing pressure, influencing overall market sentiments. Crypto market, likely to experience increased volatility and risk-off movements, though direct effects are mediated by broader macroeconomic sentiments. On forex and bond markets, well, currency valuations and fixed income instruments react to changes in trade balances, credit risks, and inflation expectation. So in each of these markets, traders must be vigilant about policy shifts and their ripple effects, as tariffs often introduce uncertainty and rapid changes in market dynamics. So it's important for us to understand these announcements that are taking place over the weekend from the Trump administration about tariffs that are affecting Canada, that are affecting Mexico, that are affecting China. Do have an expectation in whatever market you trade in that there may be adjustments. We don't know how long these tariffs will be in terms of duration. We don't know what the reaction of the other countries would also be. So whatever sector that you are in, understand one thing, that traders now are going to have to price and adjust for the tariffs that are coming through. And therefore, the market you are trading in, you need to make sure that this weekend you go and further analyze what I've provided you as a guide and see what other indicators you may find out there. The traditional traders who are trading in the traditional markets, financial markets, such as the other markets like stocks, bonds, ETFs, the non-crypto, if I put it that way, they have the trading times. In crypto, we don't have trading times. We trade 24/7 every day. We don't stop. But those markets have got the opening market. So expect adjustments to take place on Monday when the opening of your market starts. And therefore, you need to make sure that you do your further analysis now and then put your anticipation, follow what is going to take place with regards to the answer that comes from Canada, the answer that comes from Mexico, and the answer that comes from China, because then you know what's going to happen. In the past, we know that China had retaliatory measures, and they had put in some of their tariffs against some products that are going to the United States. Prime Minister Trudeau from Canada was not impressed. He is in the mood looking at what they have to do as Canada. So we don't know whether what they have to do is to sit down and talk with the Trump administration, find a solution, or the retaliatory measure. The president of Mexico, in her address, spoke about the need for them to sit down and have the diplomatic engagement to find each other. So no one knows what the outcome would be, but I can tell you that the markets, the opening of markets on Monday will be impacted by the announcement that has been made this weekend. Hopefully, before Monday, there will be a meeting of minds between the politicians so that things do not go that bad. So that's all I have for you. I wanted to make sure that you take into account that when there's these discussions about tariffs that are taking place, what is the meaning of tariffs? What is the impact of tariffs, both from the producing country to the consuming country? And what distortion does tariffs have in the market? Distortion in this way, the market has to react, has to adjust, has to risk mitigate, and therefore has to price in some of these shocks that are going through. And for you who is in the stock market, definitely the companies whose industries are affected or whose commodities are affected by this, you know exactly that there's definitely going to be an impact in terms of mitigating the risk, but also just in terms of your forecast, in terms of the earnings. So it's important for us to have this curiosity. Now that this has taken place, today the announcement has been made, let's then go out into the market and get more information. And therefore, those traders that are non-crypto traders, they know what they have to do with their open positions if they have open positions. And for crypto traders, we know what to expect. So we may have the safe haven effect where some of the traditional traders decide to move their funds onto the crypto just to go into safe haven and make sure that money at least is earning something on crypto. Again, that has a distortion effect in crypto because it affects the trading volume, right? So you who is trading in crypto, you would need to understand that movement. If that movement starts to move the crypto world in terms of the volume in crypto and as well the adjustments in crypto. And you need to also just go and study and understand which tokens would they move if they were to move into safe haven. Which tokens are regarded as safe haven by which institutions, and therefore they are likely to take a position on which one. Because then that also is going to enable you to take a position. To all my crypto traders, Solana is still doing very well. It had retraced, but like I said, it had breached one of its resistance that we've had for some time now. And the market is bullish. Market is bullish on Solana, but it's bullish on Ethereum because for a long while, the resistance that has kept the Ethereum bottoming down has really been significant. But now we've breached that resistance. So now you need to be close to your position. But however, there has been retracement. There's no straight line in trading. So you have to be very sure in terms of understanding. But however, what a lot of traders were looking at in their fib retracement, they were looking at what the next highest anticipated price would be on Ethereum. And you can look at the Ethereum ecosystem as well and check which narratives in the Ethereum ecosystem, whether it's DeFi or the games or whichever narrative in the ecosystem of Ethereum that is also likely to take off. And then take your position, but make sure you also mitigate your risk. We spoke about risk mitigation yesterday. Make sure that you follow those guidelines. We don't provide financial advice. We give you recommendations. Please use everything that provide you just as a basis point and a guide, and do your further investigation. Make your own evaluation, make your own decision, and if you trade, use your own trading strategy, because that will teach you how to trade. It will improve your trading, but also you take full responsibility for your money. That's it for this episode. Thank you very much for being with us. Really appreciate being with you. Thank you very much. Bye for now.